Imagine you saved $50,000. Every month for years, you skipped dinners out, ignored vacation deals, drove the same car with the cracked dashboard. You were disciplined. You were smart. You put that money in the safest place you knew, a savings account. And then, one morning, 10 years later, you check your balance. The number is still there, $50,000. But something is wrong, because $50,000 no longer buys what it used to. Not even close. You didn't lose the money. The money lost its meaning. And nobody sent you a warning. That is inflation. And it is not just a tax on your wallet. It is a slow, invisible tax on your patience, your sacrifice, and your future. What makes it dangerous is not what it takes from you all at once. It is what it quietly dissolves over time, while you are busy living your life, thinking you are doing everything right. Let's talk about what inflation actually is, what it does to your investment specifically, and why most people don't feel it until the damage is already done. First, the setup. Because this is not a new problem, it is an old problem wearing new clothes. Inflation is simply the rate at which prices rise over time. When inflation is at 2% per year, that means something that costs $100 today will cost $102 next year. That sounds manageable, almost harmless. And that is exactly the point. It is designed to feel harmless. In reality, 2% per year, compounded over 30 years, cuts the purchasing power of your dollar nearly in half. You did not spend the money. You did not lose the money. The Federal Reserve, which is the central bank of the United States, officially targets 2% inflation as a healthy economic goal. The idea is that a small, steady increase in prices encourages people to spend, keeps businesses growing, and prevents the economy from stagnating. In theory, inflation is controlled. In practice, it is more like a dial that no one can fully turn. Between 2021 and 2023, U.S. inflation hit levels not seen since the 1980s, peaking at over 9% annually. Grocery bills doubled in some categories. Rent in major cities surged. The cost of a used car went up by 40% in a single year. The dial slipped. And for millions of Americans sitting on savings, on retirement accounts, on what they thought were solid investments, the numbers on the screen stayed the same, while the world they could buy with those numbers quietly shrank. This is why the topic matters right now. Not because inflation is always catastrophic, but because most people have no idea how deeply it reaches into their investment returns. They see a gain. They feel secure. They do not see the portion that was already taken before they got to celebrate. Let's walk through the mechanism, the actual machinery of how inflation eats your investments, step by step. Start with cash. If you are holding cash in a standard savings account earning 0.5% interest, and inflation is running at 4%, you are losing 3.5% of your purchasing power every single year. The number in your account is growing, just barely, but the real value of that number, what it can actually buy in the real world, is declining. You are moving forward on paper and backward in life. Now let's say you move your money into bonds, because bonds are considered safer than stocks and they pay regular interest. A 10-year U.S. Treasury bond might yield around 4 to 5% right now, which sounds decent. But once you subtract inflation, which has historically averaged around 3% over long periods, your real return narrows dramatically. And if inflation climbs above your bond yield, which has happened, you are again losing ground while technically making money. The bond does exactly what it promised. The world just moved faster than the promise. Stocks are the next layer. Here is where it gets more interesting and more complicated. The conventional wisdom is that stocks beat inflation over time, and historically, that is mostly true. The S&P 500 has returned roughly 10% annually on average over the past century. Subtract 3% for average inflation, and you have a real return of around 7%. That sounds like a victory. But the word average is doing a lot of heavy lifting in that sentence. Because inflation does not average out smoothly, it spikes, it retreats, it distorts. And during inflationary periods specifically, stocks do not always protect you the way people assume they will. Here is why. When inflation rises, the Federal Reserve raises interest rates to cool it down. Higher interest rates make borrowing more expensive. Companies that relied on cheap borrowing to grow now face higher debt costs. Their profit margins compress, their growth slows, and investors, Looking for safer returns in bonds that now pay more, start pulling money out of stocks. So you get a double pressure. The company earns less, and the stock gets less attention from buyers. In 2022, when the Fed began aggressively raising rates to fight inflation, the S&P 500 dropped about 20%. Investors who thought they were protected by being in the market watched a fifth of their paper wealth evaporate in 12 months. Inflation was the spark. The rate response was the damage. Now here is the part most people skip over. The uncomfortable math hidden inside the numbers we celebrate. Let's say you invested $100,000 in a diversified stock portfolio. Over 5 years, it grows to $140,000. That is a 40% gain. You feel good. That is a real return, right? Well, let's check. During those same 5 years, cumulative inflation ran at about 22%. Your $100,000 worth of purchasing power from 5 years ago would need to be around $122,000 today just to stay even with prices. So your actual real return on a 40% nominal gain is closer to 18% over 5 years. Not 40, not even close to 40. 18, and that is before taxes on capital gains, and before any fund fees or advisory costs you paid along the way. By the time you account for inflation, taxes, and fees, some investment gains become far less impressive than the headline number suggests. Sometimes the math turns a victory into a modest gain. Sometimes it turns a modest gain into something approaching neutral. This is not pessimism. This is just the math that the brochures tend to gloss over. There is even a term for it that most financial advisors use quietly among themselves, but rarely lead with in client meetings. It is called the real rate of return. Nominal return minus inflation equals real return. That is the only number that actually tells you whether you are getting richer or just staying in place with better-looking account statements. Now let's contrast the hype with the reality. Because there is an entire industry built around helping you feel confident about your finances while quietly, structurally, working within a system that keeps inflation as background noise. You have probably heard that real estate is the best inflation hedge, and there is truth in that. Property values and rents tend to rise with inflation, which means owning real estate can protect your purchasing power. But buying real estate requires capital you might not have. Debt that now comes with 7% mortgage rates, maintenance costs, property taxes, and a level of illiquidity that means you cannot just sell a bathroom when you need cash in a downturn. Real estate works for people who can access it under the right conditions. It is not a universal answer. You have heard that gold protects against inflation. Historically, it sort of does, over very long periods. But gold generates no income. It pays no dividends. It does not compound. Over the 10-year period from 2012 to 2022, gold returned about 30% total, while the S&P 500 returned around 250%. Gold did protect against currency collapse scenarios in theory. In practical terms, over that specific decade, it severely underperformed. Hedges have costs. The cost of gold is opportunity. Treasury inflation. Protected securities, known as TIPS, are government bonds that adjust their principal value based on inflation. They sound like the perfect solution, and they are a reasonable tool. But they come with their own complexity. Their yields are often low, and they are tied to the Consumer Price Index, which some economists argue underestimates the true cost of living for average Americans. The CPI does not weight housing costs the way most people experience housing costs. It does not fully capture childcare, healthcare, or education, which have risen far faster than general inflation for decades. So even the government's official hedge against inflation is calibrated to a version of inflation that may not match your version of reality. Every solution has fine print. That is not cynicism. That is just how instruments work when they are designed within a system that also created the problem. Zoom out now. Because this is bigger than any one investment account. There is a generational dimension to inflation that is rarely discussed in personal finance content. Inflation compounds across decades the way investment returns do. The dollar that your parents earned in 1985 had roughly 3 times the purchasing power of a dollar today. That means wealth held in cash across that period lost 2/3 of its real value. The people who owned appreciating assets, stocks, real estate, businesses, captured the gains from a growing economy while also protecting themselves from inflation's erosion. The people who held savings accounts or lived paycheck to paycheck absorbed the full damage with none of the upside. Inflation, over long enough timelines, transfers wealth from people who hold cash to people who hold assets. That is not a conspiracy. That is just arithmetic applied to decades. Which raises an uncomfortable structural question. If the system is designed around 2% inflation as a baseline goal, and 2% inflation over 30 years cuts purchasing power in half, and the assets that protect against inflation, real estate, equities, private businesses, are primarily owned by people who already have capital to invest, then what does that mean for the person who is just starting? Who has student debt? Who cannot afford a down payment? Who is trying to build from zero in a world where the baseline assumption is that their dollars will be worth less every year? The math is not working against the system. In many ways, the math is the system. And yet here is where it gets genuinely interesting, because the story is not simply bleak. Understanding inflation's effect on your investments does not mean accepting it passively. It means recalibrating what success actually looks like. A 10% nominal return during a 4% inflation year is not the same victory as a 10% return in a 2% inflation year. Measuring your performance in real terms, not nominal terms, changes which decisions make sense. It changes how you evaluate funds, how you think about asset allocation, and how you approach the question of whether you are actually building wealth or just building a number. Diversification across asset types with different inflation sensitivities, regularly reviewing real returns rather than nominal ones. Understanding that your investment horizon matters enormously. Because inflation averages out better over 30 years than over 3 years, these are not revolutionary ideas. They are just ideas that require you to think in a slightly less comfortable way than the account statements encourage. The inconvenient reality is that there is no investment that perfectly neutralizes inflation under all conditions. What exists is a range of imperfect tools, each with trade-offs, each with their own embedded risks, each requiring you to make decisions under uncertainty with incomplete information. That is not a system failure. That is just investing. The failure is in pretending otherwise. So here is the question worth sitting with. If inflation is a known, documented, mathematically certain drag on every dollar you hold and every return you earn, and if the tools available to fight it are all imperfect and context-dependent, and if the financial industry has a structural incentive to show you nominal returns rather than real ones, then what does it actually mean to protect your financial future? The honest answer is that nobody fully can. Not without trade-offs, not without risk. The best you can do is see clearly, measure honestly, and stop mistaking the number for the thing the number is supposed to represent. Your $50,000 is still in the account. The number has not changed. But in a world where prices have moved and time has passed, the question is no longer how much you have. The question is what it is actually worth. That gap between those two questions is where inflation lives. Every single day. If this kind of thinking is useful to you, share this video with someone who still judges their investments only by the number on the screen. Like it if the math hit differently than you expected. Leave a comment with what inflation has actually cost you in real terms, because those numbers are always more revealing than people expect. And subscribe if you want more content that skips the comfortable version and goes straight to what is actually happening. The next video might be harder to watch than this one.